Welcome to the next installment of our Investment Guru session, where we focus on the investment capabilities within momentum asset management and momentum alternative investments. Today you will hear from our practitioners and knowledge experts how their thinking is evolving and how they are positioning their portfolios for the future of investments. Just looking at the changes in the world over the last few years, it is evident that there are significant changes that are playing out at the moment. Just as we seem to be reaching the point where the COVID pandemic seems to be becoming more manageable, there are other key factors and events shaping our world. At the time of this recording, the most extreme and top-of-mind driver is the Russian invasion of the Ukraine. This is clearly showing the fault lines between the developed West and the developing East. Even multilateral organizations that were born out of the aftermath of the Second World War no longer seem fit for purpose. Think, for instance, about the veto powers that the so-called military superpowers have, who no longer necessarily seem to be economic superpowers. The most recent example is Russia vetoing the vote against the Ukraine. The US has also done the same with Iraq and Afghanistan. There's also a movement of the global economic center eastwards as China and other large Asian countries become increasingly economically and militarily powerful. One can build the argument that the current period of geopolitical instability that we are seeing is in part a consequence to the US losing, or at least to be perceived to be losing, some of its power globally relative to other significant players. This period of transition is likely going to be the defining event of our times and will very likely result in reorientation of global spheres of influence, new political clusters, and economic alliances and choices that need to be made. In addition, South Africa continues on its path of relaxation of exchange control as we continue on our journey of integrating more and more deeply into global financial systems. We do know that what markets hate most is uncertainty. The worst phase of the market is proven to be when there is most uncertainty. But have we reached the peak of that uncertainty? Today you will see how our investment professionals are preparing and positioning for this world, starting first off with the economic context by our in-house economist, Sandisha Pakarisamy, and how this translates into our views on an asset class expectation level by Herman van Papendorp. Our portfolio management team will follow with Wayne Dennehy talking about our smart beta equity portfolios, Ian Scott about our fixed income portfolios, and Pelly Wanyeneng about our property portfolios. Alternative assets are increasingly coming into focus, part driven by the infrastructure imperative from the President's office. Kamini Naidu will give us an update on the lay of the land in our alternative investments team. We do invest for our investors. That is our holy grail. Paul Nixon will unpack a little bit of the behaviors and the psychology of investors as he talks about the latest initiatives in our behavioral science area. Tutor Blanche will close off today, concluding with a business update. Please note, we applied for continuous professional development points. So please watch the full session and add your ID and FSP number to the CPD section so we can verify your attendance. The CPD certificates will be mailed to you after the Financial Planning Institute's accreditation is finalized. Please post your questions to the speakers in the question and answers section, and our speakers will answer you. Our event platform will remain open, and you will also be able to receive CPD points until the end of March this year. I do hope that you enjoy this session and find it a valuable addition to your knowledge gathering and in our turbulent times and rapidly evolving world.
Many countries are assuming the reality of having to live with the COVID-19 virus through maintaining certain health protocols instead of actively fighting the virus through restricting economic activity. As such, in this new phase of the pandemic, global central banks and fiscal authorities are switching gears from rescuing the economy at any cost to beginning to normalize policy in the current economic recovery. The unprecedented cutting of interest rates and the expansion of balance sheets certainly averted a deeper and more prolonged economic downswing. But this has led to a stellar year of growth, with the International Monetary Fund forecasting an expansion in global growth of nearly 6% last year. Nevertheless, the pace of global recovery is set to decelerate. Relative to the March 2021 peak in global growth forecasts for this year, consensus estimates for growth have migrated lower in both developed and emerging economies. That said, the consensus still expects growth in the major regions to exceed their longer-term potential, despite the downside risks of less policy support, geopolitical conflict, additional more deadly variants of COVID-19, and a de-anchoring in inflation expectations. Moreover, chart 2 over here shows us that high-frequency data on global economic activity have surprised market forecasts in the last while, which should arrest the pace of downward revisions for expected growth for this year. One of the drivers behind the initial cuts to global growth forecasts was the imposition of renewed lockdown measures at the outset of the surge in the Omicron variant in early November last year. While this chart shows us that the average developed market tightened measures, the average emerging market tightened restrictions by far less, and many countries actually pushed to relax rules given Omicron's perceived milder level of infections. Moreover, post the pandemic, emerging markets have had far less monetary and fiscal ammunition available to combat the effects of a slowing economy, which has likely persuaded authorities to keep a lighter level of restrictions in place. Although developed markets have taken a higher level of precaution with their lockdown measures, the level of stringency was still far lower than in previous waves. This is partly owing to a higher level of vaccinations in the developed world, but also a shift in health regulations, including vaccination mandates, which allow for normal activity to resume, even in previously pandemic-stricken sectors, such as entertainment or even hospitality. For that reason, the latest tightening in lockdown restrictions has not affected mobility indicators as severely as what we've seen in previous waves. This has resulted in milder downward adjustments to growth estimates. The IMF has shown that major epidemics in the last 2 decades have been followed by periods of increasing inequality, and the degree of fiscal consolidation plays a very significant role in determining the extent of the rise. Given the size and the duration of policy support measures in developed markets, as well as a higher level of vaccination, output in these nations is anticipated to reach pre-pandemic levels a lot sooner. Amid this multi-speed economic recovery, emerging markets are likely to lag, particularly lower-income developing economies, which are likely to struggle for years with the after-effects of the pandemic. While initially low inflation gave emerging market central banks some room to cut domestic interest rates substantially and engage in unconventional policy, rising inflation risks have forced many to pivot towards an unwinding of ultra-accommodative policy even before developed markets have seen a lift-off in interest rates. On the fiscal front, economic relief measures added to the stockpile of government debt, with the average emerging market government experiencing a 10% rise in government debt levels since 2018. As such, with less fiscal room to support an ongoing recovery, output in emerging markets in aggregate is expected to reach pre-pandemic levels over a much longer time frame. This chart shows us that the outputs in the emerging market composite, with the exception of China, will still be more than 5% lower than pre-pandemic levels by the end of next year. The rate of vaccination continues to drive a wedge between the performance of higher income economies and that of poorer nations. Even though the globe is closing in on having administered nearly 10.7 billion vaccine doses, vaccination coverage remains highly unequal. More than 3/4 of those living in developed markets have received at least one vaccine dose. But this is in striking contrast to low-income economies, where only 12 people in every 100 have received one vaccine dose. Now, if this current pace of vaccination persists, only 1/3 of the population in low-income economies will be inoculated by the end of next year. Possible new variants of the virus could leave even highly vaccinated countries at risk, and this could trigger renewed lockdowns. The IMF suggests that if manufactured vaccines had been equally distributed, the amount would have been sufficient to cover all healthcare workers and the elderly globally. Nevertheless, vaccine inequity has left a huge gap between the number of vaccines secured in the grey bars on this chart and the number that has actually been delivered in the blue stripes. This level of vaccine inequality gives rise to dangerous mutations in the COVID-19 virus that could raise vaccine ineffectiveness. This remains one of the major downside risks to global growth prospects in our view. Another key concern to the trajectory of the globe is stronger and longer-lasting inflation pressures. Inflation is running hot on persistent critical supply shortages and geopolitical pressures underpinning a surge in international oil prices. Energy prices are the key global transmission channel in Russia's assault on Ukraine. Higher energy inflation could squeeze real incomes further and could shave off more than 1/3% from global GDP, with the Eurozone experiencing a much harder hit than the US. As long as there are no permanent reductions to oil or grain supply, the surge in prices is likely to be short-lived. Additional structural damage could nevertheless trigger further significant upward revisions to inflation and downward revisions to growth. Other areas of the inflation basket have seen some reprieve. Despite goods inflation running at 5%, services inflation for the average OECD country has tracked at a far lower 2%. As the global economy recovers from the pandemic, demand should start to rotate from goods into services categories, allowing for goods inflation to start to return to more normalized levels. The Global Supply Chain Pressure Index, developed by the New York Fed, reached a new all-time high in November last year, but the latest data shows a tentative turnaround. One of the components of the index, the Baltic Dry Index, has fallen sharply in the past 2 months, suggesting a significant drop in shipping rates. In addition, Bloomberg reported that freight costs to send liquefied natural gas from the US to Europe turned negative for the first time in history in the middle of February, given the growing glut of ships ferrying American fuel. Inflation typically becomes more worrisome when workers in the jobs market respond to rising prices with demands for even greater wage increases, creating a wage price spiral. So far, this has not yet occurred, as can be seen in this chart. What's more is that accelerated investment in technology has boosted productivity, which can provide some offset to a rise in wages. In addition, longer-dated inflation expectations have remained reasonably well anchored in much of the developed world. Monetary policy authorities in developed markets are becoming concerned that cheap money has prevailed for too long. Stubbornly high price increases have further accelerated the pivot towards a quicker and sharper unwinding of ultra-accommodative monetary policy conditions. Nevertheless, with labor market dynamics and underlying inflation differing across the developed market composite, monetary policy responses are likely to diverge. In our opinion, a faster recovery in the economy and jobs market in the US and UK calls for more urgent action this year, while a lingering unemployment gap and benign underlying inflation in the Eurozone and Japan allow for a later liftoff in interest rates. With global authorities shifting gears from rescue to recovery, South Africa is following suit. But although SA experienced a notable rebound in economic activity off the back of previous stimulus measures, it is going to be much harder to sustain growth from here. Although faster than expected global growth, sustained commodity prices, a bounce back in pandemic-stricken sectors, or a faster timeline on reform could result in an upward revision to growth, we believe that downside risks still outweigh. Sustained high global inflation, spillover from the Chinese property sector, less accommodative policy locally, persistent energy supply constraints, and overarching structurally high unemployment continue to pose significant risks to local growth. Although tax revenue shortfalls were a recurrent theme in South Africa even before the pandemic, we were more recently gifted with a commodity price boon which lifted company taxes. This created room for an expansion of stimulus measures and an overrun in the government wage bill. Nevertheless, the windfall gains from commodity prices are unlikely to last forever, and a sudden correction in commodity prices could threaten the funding for any permanent expenditure outlays. Therefore, while favorable commodity prices have brightened the near-term outlook, we maintain a more cautious stance in the medium to longer term. In particular, three major risks cloud the outlook for government's fiscal consolidation efforts. These include restraint on the civil servant wage bill, having to meet rising social demands to address crippling inequality, and further assistance to ailing state-owned enterprises. A faster than anticipated recovery from the pandemic and a positive surprise on South Africa's near-term fiscal and debt metrics should stave off any negative rating actions this year. However, we remain concerned about the outlook for the sovereign rating further out. Years of tepid growth have translated into weak progress in improving living standards for all South Africans. With trend growth hamstrung by infrastructure bottlenecks, unnecessary red tape, and policy uncertainty, the IMF shows that SA is likely to underperform the bottom quartile of countries in the next few years. The Fund for Peace shows that the Fragile States Index improved for South Africa in the last 3 readings, but there has been an overall negative trend in the last decade. From the underlying data, it is apparent that security, the state of the SA economy, and public services are contributing to a high level of fragility. SA has seen the largest deterioration in the security score in the past decade, implying greater distrust in domestic security, more organized crime, and a higher risk of violent uprisings. In a similar vein, the index measuring the state of the economy has deteriorated significantly in the past decade, shifting the country from the worst position in its selected peer group. In our view, these challenges are unlikely to be met with an overnight fix and will continue to burden the sovereign rating in the medium to longer term. Should SA underperform its peers as expected, the bias to the rand remains weaker. Nevertheless, the pass-through from the currency into the consumer basket remains relatively muted, so much so that South Africa experienced somewhat an atypical response in this latest surge in global inflation. While headline inflation in developed and emerging markets spiked to levels significantly higher than their longer-term averages, this chart shows that the recent moves in inflation locally do not appear out of kilter with the longer-term historic trends. We also expect low services inflation, weak demand, and anchored expectations to keep inflation well within the target range in the medium term. Therefore, in our view, although we expect up to at least 3 interest rate hikes of 25 basis points each this year and a terminal rate of below 6% in the cycle, stable inflation expectations and a high level of central bank credibility are expected to stave off a higher interest rate profile. In summary, although global growth expectations have softened, forecasts remain well above trend. Nevertheless, downside risks to the economic recovery have not disappeared. As long as rates of vaccination remain low in poorer economies, the risk of more virulent forms of COVID-19 remain a threat. Moreover, geopolitical tensions and sustained supply chain bottlenecks are likely to keep inflation higher for longer, and this is expected to result in a front-loading of central bank tightening from a very ultra-accommodative position. Fortunately, in South Africa, local inflation is expected to remain contained on idiosyncratic factors, and as such, this lowers the risk of significantly tighter interest rates relative to our own forecasts. Thank you for your time today.
Hello everyone. When we contemplate the probable outlook for asset classes in 2022, we think there are three known unknowns that are likely to determine how financial assets will perform this year. Let's call them the three Ps. The pandemic, politics, both global and local, and probably the most important, global policy. While it is known that these variables are going to be very important for the outcome of financial markets this year, it is unknown how these variables will turn out or how financial assets will respond to their behavior. Let's talk about the pandemic first. It seems that more and more countries have started to move away from a zero-tolerance stance towards COVID-19, realizing that the severe economic hardships caused by the strict lockdowns required by such a stance are mostly ineffective in containing the virus and counterproductive for the general well-being of their populations. Even more so, if rising vaccination rates minimize severe illness and mortality rates among residents, or if new virus mutations become less lethal. As a result, the negative growth impact of each new COVID mutation wave is likely to become less severe going forward, unless vaccines become less effective against new virus variants, or if new mutations become more fatal, which would then lead to renewed spikes in hospitalization and mortality rates and a much more severe economic downturn, or even recession. What about politics? Well, financial markets would be roiled when there are increased geopolitical tensions, as now seen between Russia and the West due to the Ukraine invasion, or between the US and China, whether on the Taiwan issue, military tension in the seas around China, or altercations on the trade front. As always, North Korea's nuclear ambition and instability in the Middle East continue to lurk in the background as potential additional threats to geopolitical stability. If we use the Russian annexation of Crimea in 2014, the American invasion of Iraq in 2003, and the 1990 Gulf War as our signposts, this chart shows that the effect of Russia's invasion of Ukraine on financial markets is likely to be marginal and temporary. While the global equity market has been pretty weak in the run-up to these previous conflicts, the markets recovered pretty soon afterwards. Of course, the Russia-Ukraine conflict will naturally be associated with high levels of market volatility, as long as there is uncertainty about how events will ultimately unfold. Our basic premise is that if Russia-Ukraine remains a regional conflict that does not escalate into a global destabilizing event, it should fade as a meaningful driving force for financial markets beyond the short term. In the interim, risk-off sentiment will likely be prevailing at times of tension escalation, with risky asset classes like equities experiencing some short and shallow drawdowns, and safe haven asset classes like the US dollar, gold, and global bonds rallying during these periods of conflict escalation. In our view, geopolitical events like these are likely to only be secondary factors to the more primary fundamental driver for financial markets this year, namely the major global policy transition from the massive monetary and fiscal stimulus of 2020 and 2021 to eventual policy tightening in 2022. How financial markets react to this policy pivot will be much more crucial for the relative performance of different asset classes than what happens in Russia-Ukraine. At most, the situation in Ukraine reinforces our view that the global policy pivot in 2022 should culminate in a less conducive backdrop for asset class returns and could lead to periodic drawdowns in riskier asset classes this year. Geopolitical events like these again highlight to investors the advantages of having a diversified investment portfolio. While some asset classes in an investment portfolio could experience short-term drawdowns when risk-off sentiment prevails, think of risky asset classes like global equities, other factors like a weakening rand would soften the return effect for rand-based investors, for example. Similarly, while there could be near-term pressure on South African bonds from global risk-off sentiment and a weaker rand, some South African equity sectors will benefit from higher commodity prices and a weaker rand. Within South Africa, any market-unfriendly political outcomes from the ANC's policy conference in mid-2022 or its elective conference at the end of the year would be quickly reflected in lower local asset prices and a weaker rand. Also, risks to South Africa's economic growth from elevated frequencies of Eskom load shedding in the coming year or disappointing progress on economic reforms would result in an increase in South Africa's risk premium as an investment destination. And now to the big gorilla in the room, policy. 2022 will be a year when we are likely to see a major global policy transition from the massive monetary and fiscal stimulus of 2020 and 2021 to eventual policy tightening. How financial markets react to this policy pivot will be crucial for the relative performance of the different asset classes this year. An exaggerated cyclical global recovery last year from the pandemic doldrums of 2020 was almost inevitable after, firstly, the massive monetary and fiscal stimulus dished out by policymakers around the world in response to the COVID-19 crisis, and secondly, the improved mobility experienced in 2021 versus the lockdown conditions of 2020. In the same vein, a global growth slowdown in 2022 from the heady heights of last year looks a mathematical certainty, particularly against the backdrop of peaking policy stimulus. Not only are the quantitative easing support from global central banks peaking, but a more general trend of rising interest rates will soon become prevalent. Financial asset prices have been hugely supported by the abundant stimulus in 2020 and 2021. The transition in the policy environment in 2022 from previous massive stimulus to less stimulus, then to no additional stimulus, and eventually to policy tightening should culminate in a less conducive backdrop for asset class returns and could lead to periodic drawdowns in riskier asset classes. How important quantitative easing has become for equity returns is aptly illustrated by this chart, showing that since the global financial crisis, QE in red has become twice as important as a US equity return driver than profits. Before the global financial crisis, profits were basically responsible for almost half of the returns of the US equity market. But after the global financial crisis, this has fallen to only 21% of equity returns. In contrast, the growth in the US central bank's balance sheet is now the driving force for 41% of US equity market returns. In addition to the likely negative equity return impact of the move from quantitative easing to quantitative tightening this year, the anticipated slowdown in profit momentum associated with lower global growth also points to a lower global equity return outlook in 2022. However, the magnitude and longevity of any potential equity sell-off will be limited as long as the global economic recovery remains broadly intact and broad-based, as is currently still the case. At least the anticipated growth slowdown around the world at this stage looks to be mild enough to keep growth rates well above trend levels in 2022. There is, of course, the risk that if global central banks are forced to take a more aggressive policy normalization path in an effort to contain more severe inflationary pressures, this could destabilize financial markets that have become accustomed to historically low interest rates and are priced for a very slow and gradual path to eventual monetary policy tightening. The expected turnaround in the QE cycle going forward should also be a negative fundamental demand factor for global bond yields. This chart shows that in the US, the Fed has been a major demand source for treasury issuance since the global financial crisis, and again since the pandemic. So much so that the Fed now owns almost 30% of all outstanding US Treasury securities. But this Fed demand will disappear when QE ends, at a time when Treasury issuance will rise further to fund huge fiscal programs in the US. The supply-demand dynamics for the US bond market is thus likely to deteriorate markedly in 2022. In conjunction with inflation that is proving to be more persistent than previously thought, this points to higher bond yields going forward. That caution is also warranted on global bonds as rising policy rates loom is evident from US asset class behavior around the start of previous rate hiking cycles since 1977. While US equities in the blue dotted line rose in the run-up to the first Fed rate hike, bond yields in the red dotted line also rose in the run-up to the first Fed hike and continued to rise subsequent to that hike. The recent behavior of US equities in the solid blue line and US bond yields in the solid red line have broadly followed the historical script. If historical precedent also prevails this time, one would expect a volatile but broadly sideways US equity market trend in the next year and a further rise in US bond yields. What would be more problematic for equities is an aggressive spike in bond yields. For instance, if the bond market perceives the Fed to be behind the curve on fighting inflation. When US bond yields historically rose by 50 basis points in a month, returns for the US equity market were negative in the immediate aftermath of that spike, while returns up to a year after the spike were weaker than normal. It would be difficult to argue that any of global equities, bonds, or cash are currently exhibiting great value in isolation, with the US equity forward earnings yield close to 5%, the yield on 10-year US Treasuries close to 2%, Japanese and European bond yields scarcely above zero, and global cash yields around zero. These expensive valuations put a major constraint on the future returns that can be expected from each of these global asset classes in 2022 and beyond. This is one of the reasons why our preference is for South African assets over global assets this year. If US real bond yields rise in line with tighter monetary policy as we expect, this should benefit the rest of the world's equity markets over the US market with its long duration growth characteristics. In addition, as the US equity market has recently outperformed the rest of the world despite an inferior profit performance, this has opened up a record US forward PE premium, which improves the future relative return potential for non-US equities. South African equity market returns in 2021 were derived from a strong profit rebound that overshadowed a valuation derating. This is likely to reverse in 2022, with pressure on profits expected from a slowing in global and South African economic momentum on top of the high profit base created in 2021. This means that returns will have to come from a re-rating in market valuations. Fortunately, the South African equity market valuation picture looks reasonable. Even if we assume no earnings growth in the next year, the South African equity market is now trading in line with its forward PE average since 1999. Also, South African equities still trade at huge valuation discounts to the rest of the world, with South African equities cheap versus emerging market equities, one standard deviation below long-term averages, and very cheap versus developed market equities, more than 2 standard deviations below long-term averages. The global spike in inflation has further eroded the real government bond yields available in the developed world, with most developed countries' real bond yields in significantly negative territory. Although South Africa's inflation rate has also risen meaningfully, the high real yield still available in South African bonds stands in stark contrast to those in the developed world and even among the emerging world. It stands to reason that the high South African real bond yields already discount a high fiscal and country risk premium. But not only are South African real bond yields currently attractive versus developed market and emerging market yields, South Africa's real yield premium versus the rest of the world is also high against historical averages. Finally, South Africa's real yield is also almost 1 standard deviation higher than its own historical average. In the inflation-linked bond space, there is little scope for further break-even widening in the interim, with inflation expected to peak in the first quarter of 2022. Smaller monthly inflation accruals should also provide less fundamental support for the asset class until the second quarter of 2022. After the recent rate hikes by the South African Reserve Bank, the prospective South African real cash yield has risen to above zero, but this is still half a standard deviation below its historical average. Relative to South African equities and cash, South African nominal bonds in red have consistently been the cheapest asset class since 2013. Aggressive COVID-related rate cuts by the South African Reserve Bank have made cash in blue the most expensive asset class since 2020. While sharp profit upgrades in 2021 have pushed South African equity valuations in grey to lower levels. Sector fundamentals in the listed property sector remain negative, with rising vacancies, falling escalations, negative rental reversions with a focus on tenant retention, and sharp rises in operating costs, the order of the day. Our expectation is that listed property values will have to decline by 10 to 15% peak to trough to account for these negative fundamentals. However, values have already declined by 9.6%, so we think a large part of the negative fundamental backdrop has already been discounted. In essence, we need to weigh decent potential property returns from here against the fundamental risks and uncertainties in the sector. So let's summarize the 5 key takeaways from our outlook for asset classes this year. Firstly, the transition in the global policy environment in 2022 from less stimulus to eventual policy tightening should culminate in a less conducive backdrop for asset class returns and could lead to periodic drawdowns in riskier asset classes. But as long as the global economic recovery remains intact as we expect, the magnitude and the longevity of any potential equity sell-offs should be limited. Secondly, the move from quantitative easing to quantitative tightening and inflation proving to be more persistent than previously thought are negative fundamental factors for global bonds, pointing to higher bond yields and lower returns going forward. Thirdly, although global equities look cheaper than cash or bonds in relative valuation terms, widespread expensive absolute valuations across the global asset classes put a major constraint on the future returns that can be expected from each of global equities, global bonds, and global cash in 2022. In contrast, we think the much more favorable valuation picture of South African equities should enhance the return prospects from this asset class. Fourthly, South African nominal bonds remain the cheapest domestic asset class, as has consistently been the case since 2013. South African real bond yields also remain attractive versus developed market and emerging market yields. And finally, we think a large part of the negative fundamental backdrop for South African listed property has already been discounted. In closing, I would again strongly advise investors to leave it to their financial advisors and investment managers to make sure that their investment portfolios remain positioned appropriately to attain their long-term investment goals. Responding emotionally to any short-term effect that a geopolitical event like the invasion of Ukraine by Russia could have on a portfolio has a high probability of permanently destroying long-term portfolio returns.
Good morning. We have the next 15 minutes for me to share with you what has happened in equities, both in the local market and from an offshore perspective. I'm going to break this conversation down into 4 parts. Part 1, I'm going to have a look at what happened in SA equities in the last 12 months and what happened from a global perspective. What are the stories? What are the themes? Part 2, I'm going to have a look at what happened in the equity markets that were tracking the capped SWIX index fund as a benchmark, and what happened in the local market where we were tracking the JSE All Share Index. Third part, we're going to have a look at, was there value being created by active equity management in our SA markets? And finally, how did the momentum smart beta funds perform during these markets? Let's recap what's happened in markets in the last 12 months. I think we would all agree what we've seen in our markets in the last 24 months has been something very, very unique. something I have never seen in my career before, and to be perfectly honest, something I hope I never ever see again. If we start with local equities on the left-hand side of this graph, shown in blue, we can see that the capped Swiss index had a very strong year, with SA equities up around 27% for last year. And the sectors all showing strong returns: resources, industrials, financials, and even property. Strong year for 2021. In the fixed income space, inflation-linked bonds was the place to be, with that asset class up around 16% for last year, and cash showing the worst returns in many years, where investors invested in cash only had a return of around 4%. If we look at precious metals and at oil, I think if we think back, at the start of COVID, oil went as low as $18 a barrel in March, April of 2020. And many of us might even recall that oil futures went negative, something that's mathematically possible, but something I certainly haven't seen very frequently. On the gold side, gold had a very slow year last year, not surprisingly, but gold performed extremely well during the start of COVID, exactly as one would have expected. And on the platinum side, platinum actually had a very good start to 2021 in the first 4 months, but it came under enormous pressure in the back end of last year as there were concerns from the Fed around possible rate hikes and supply concerns on the chip side, which I even managed to experience firsthand when I ordered a new laptop in November last year, and it took nearly 3 months for me to get that laptop. On a more global perspective, strong returns from the various offshore equity side. If we start with the S&P 500, that market was up nearly 39% for last year, but it really was a FANG stock issue. Facebook, Alphabet, Netflix, and Google performing extremely strongly, and some of our pharmaceutical stocks. The interesting point to note, though, was how the more developed equity markets performed compared to our EM markets. On the DM side, we saw strong returns, 31% from our more developed markets. But on the emerging market side, you only earned around 4%. Again, showing the need to be well diversified in this space. And the rand slightly weaker, as we saw, about 9% weaker for 2021. If we look at it over a 3-year perspective, pretty decent returns. I mean, you earned around 11% per annum from SA equities in the last 3 years. Financials weren't great. If you were invested in banks, insurance companies, or medical schemes, you only got a return of around 1.5% for the last 3 years. Resources doing great, and properties having a negative returns. Fixed income all looking good, and gold, interestingly, outperforming SA equities over the last 3 years. And from a global perspective, everything looking great. Strong returns pretty much regardless of where you had your funds invested globally. If we take that through to a 5-year view, pretty modest absolute returns, in the sense that we only got around 7% returns from SA equities in the last 5 years. You can see financials still actually struggling, and the real star there being our resource sectors. And if you want to pick one share that actually tells that resource story, have a look at Anglo's. I remember distinctly when I joined Momentum in January 2016, the market was a little bit skittish, and the Anglo share price actually dipped down to around 55 Rand per share. When I checked yesterday, that share price was over 800 Rand a share. A great, great commodity super cycle. If you look at gold, gold also outperforming SA equities over the last 3 years, and from a global perspective, strong returns if you had your money invested offshore. Interesting to note that in Rand adjusted terms, you actually got more than double the return if had you been invested in the S&P 500 as opposed to being invested in local equities. This is a great slide that we'd like to look at in terms of trying to understand where did the market returns come from last year. So the 27% return that we saw in Cap Swiss, if you look at the far right-hand side of the graph, the big blue pillar shows the 27% return that we got from Cap Swiss. What we're then showing in the various yellow bars is what shares positively contributed to that 27%, and in the red bars, what shares took away from that market return. On the left-hand side, you can see that shares that actually contributed to that return, MTN, Anglo, Sasol, Richemont, FirstRand, all shares that you see in the top 5 of both Cap Swiss and All Share. The interesting story to me is on the right-hand side. What shares took away from market returns in 2021? And there we see Naspers. Naspers actually pulled the market down by nearly 2%. And fascinating to me that in a year like last year, where SA equities were up around 27%, Naspers was in fact down 20% for calendar year 2021. And Process not featuring that much better. a very big difference to what we've seen in recent years, where Naspers has actually been running and pulling the market up with it. A key point for us to just reflect on is the whole concept of what is the equity benchmark of the funds that we choose to invest in. And what I'm comparing on this slide is how has capped SWIX performed relative to JSE All Share. So just to remind ourselves, capped SWIX was actually brought about because 5 or 6 years ago, we were really concerned about the large concentration limits in 2 shares. At that particular point, Naspers, which was around 15% of the market, and SAB, which was prior to the actual unbundling that later took place, also at around 10%. And what the capped SWIX says is no share can be more than 10% of the market benchmark in its particular market index. And what it's showing on this graph is that had you invested 100 Rand in the market 5 years ago into an SA equity fund where the benchmark was capped SWIX, you would have got a return of around 42% over the last 5 years if that equity fund had given you exactly what it was trying to track. The red graph shows what would have happened had you invested into a SA equity fund where the benchmark was JSE All Share. And in that case, you would have got a return of 71% over the last 5 years. Now that's a massive difference, right, between what capped SWIX would have given you compared to what the JSE All Share has given you. And it's a strong reminder to all of us that if you're going to go and compare 2 different equity funds, make sure you understand what is the benchmark of that particular SA equity fund. Because if you look at those 2 graphs, you would quickly think, well, this particular red asset manager has done far better than the blue asset manager in the last 5 years. But in fact, they've given you exactly what each of their particular benchmarks was. So when you're going to compare funds, make sure you understand what their benchmark was, because you can make significantly wrong decisions around which manager actually has skill and which manager doesn't. The third topic we're going to look at is there value being created by active equity managers for clients in the SA equity space? And this is a graph we showed before where we look at, on a rolling 12-month basis, on average, are SA equity funds that are being actively managed, are they capable of beating the market benchmark, or are they capable of beating the market on average? So what the graph shows you is if the yellow pillars are above the x-axis, on average, active equity funds are adding value for clients. They're managing to beat the market benchmark or beat a normal index fund. And what it shows quite clearly is that in the last 5 years, it's been the time to be invested in active equity mandates. But it also shows us that there are significant periods in time when active managers struggle to beat the market or beat the benchmark consistently. So there's always place for index funds in how we think about portfolio construction. What it doesn't show you as easily, though, is that as of the end of December last year, there were around 164 SA equity funds with a 1-year track record. And on average, had you bought all 164 funds, you would have beaten the market by around 0.5%. So there's value being created. But the best equity fund last year gave clients a return of around 60%. The worst equity fund last year gave clients a return of 4%. So while the average managed to beat the market, there's a huge range between the best and the worst. So while there's value to be had investing actively, your manager selection process is absolutely vital. And that's where your retail DFMs, your institutional DFMs and multi-managers have a huge role to play in choosing the correct equity funds for you to invest in. On the property side, a very similar story to what we showed last time. Consistently through time, there's better value for clients to be invested in actively managed property funds as opposed to buying a more passively or a market tracking property index fund. Consistently, there's value being added for clients in the active space. So how do we bring it together? What do we think about? Well, I just mentioned there were 164 funds at the end of last year with a 1-year track record. So when you think about building out your SA equity building block, clearly you have a big universe of active managers that you can go and choose from, all trying to create value for clients, trying to beat the market in different ways, through their process, through their philosophy, be it a growth house, a value house, a sort of quality house, it really doesn't matter. On the other side of the market, you've got your passive index funds, such as the Momentum Capped SWIX Index Fund. You'll buy the market fund, no chance have I bought the wrong manager, I'm going to get the market very cheap on fees. And then you've got your smart beta funds, somewhere in between those two styles. If you look at a time series of their fund returns through time, you would really quickly come to a conclusion that thinks this is a very good active manager. But in fact, it's a smart beta fund. It's a systematic process that tries to beat the market consistently, but in a way slightly differently to what your normal active managers are actually doing. And the trick to win this game in SA equities is to have a well-diversified exposure to all three of those. Have a mix of different active funds, have some passive exposure in that mix, and include smart beta funds as a way to get active equity exposure, but not having to invest into a more actively managed mandate. So how have the momentum funds done? The final part of our chat this morning. The Momentum Smart Beta Fund, would you believe, now has a 5-year track record as of the end of March 2022. And as you can see on the graph, we're showing how that fund has performed in red relative to the Capped SWIX index over the last 5 years. And it's had an exceptionally good run. It's managed to beat the market consistently by around 6.5% per annum over the last 5 years. A great way to get access to the market beating performance, but in a smart beta building block. And the Momentum Value Fund is also going to have a 5-year track record at the end of this month, and also managing to beat the market consistently, as you can see, by around 5.5% per annum since it was launched nearly 5 years ago. One question I've been asked, as you can imagine, very frequently in the last week or so is, how have these funds performed in the context of what's happening with Russia and Ukraine? And a really simple example to that is if I look at a share such as Mondi, which if you've been watching Mondi, has come under huge pressure in the last week because of its exposure that it has in Russia. But interestingly, Mondi as a share didn't find its way into either of our two smart beta funds. Why? In terms of how we filter out and how we assess whether shares are worthy of finding their place into our trending fund or into our value smart beta fund, it didn't tick the criteria. It didn't make the cut in terms of how we actually screen shares. And then when we overlaid our ESG filtering process, it again didn't make that cut. So Mondi is a really good example that our process and our philosophy stood up, and that share didn't find its way into either of our two smart beta funds. But these two funds are fantastic building blocks for DFMs, institutional DFMs and asset consultants and multi-managers to include in client portfolios to gain clean access to these two styles. And the final slide I have for you is the Momentum Core Equity Fund, which is available as a mix of everything I've spoken about. So it's effectively a blend of a Capped SWIX fund and our three smart betas. So it's a blend of those three strategies plus the market. And as you can see, also has a 5-year track record at the end of March, and again done exceptionally well relative to its peers and relative to the Capped SWIX index. And all three of these funds, our core equity and our two smart beta funds and our quality fund that I haven't spoken about this morning, you can access them via Momentum Unit Trusts, Momentum Wealth, or for institutional clients through a policy or through a segregated mandate. Thank you.
Good day, everybody. Today I'm here, we're going to talk around fixed income and what a big difference 2 weeks really does make in the world. If you listen to an earlier presentation in January that I did, I said it's all about the Fed this year. Can you believe how the world has changed within 2 to 3 weeks, and that the geopolitical events in Eastern Europe is actually overriding the biggest central bank in the world at the moment. Yes, the Fed is still going to hike rates, but we have clearly seen over the last 2 to 3 weeks that the market was expecting the Fed to hike about 7 times this year to around 1.5%. It's clearly been tapered back, and the market now says, well, the Fed will probably not hike by 50 basis points at the March meeting anymore, probably 25 basis points, and they'll probably hike 4 to 5 times this year. Very, very different interest rate profile out of the dollar market. If we think about the other central banks, we know that the Bank of England is very hawkish, but maybe they'll go a little bit slower as well. The ECB was expected to hike somewhere in 2022. Maybe with what's happening in Eastern Europe, the ECB will probably also not have to hike rates in 2022. Can you believe it? So what has really changed is geopolitical risk. So at the end of February, beginning of March, we've obviously had this whole situation around the Ukraine, and it has affected markets. Why? What's important? So we look at an index called the MOVE Index. What is the MOVE Index? It's an index that tracks the volatility of US bonds or US treasuries as it's called. And as risks in the world rises, this MOVE index goes up and the bond market gets worried. Think about it. When we stood up in the beginning of the year, we said US Treasuries are probably going to be well above 2%. They've rallied hard. They're probably at 1.7%, saying to us, there's a lot more risk in the world. There's a flight to safe havens. Bonds is going to be the place for safe havens. And we've seen a big move back into the dollar and back into US Treasuries. Are we then surprised that bonds rally, especially developed market bonds? That's not always true for all bonds in the world, and we'll look at the different sectors in bonds. So right, developed market bonds. So we said interest rates are going to go up. The central banks in the world is going to hike rates. Now we say, woo, they're going to hike rates, but it's probably going to be at a slower pace, less rate hikes. Bonds are not going to go as high as we initially thought because of so many uncertainties. What does this geopolitical risk actually mean for bond markets? So what's been happening in developed market bonds? So we said earlier in the year, central banks are going to hike rates, nominal bond rates are going to rise, that US Treasury will probably go to around 2.5%. Now we're saying, whoa, central banks are going to hike rates slower. Those bond yields may not go as high as 2.5%. In fact, they're well below 2% at the moment. The German 10-year bond, remember it was at minus 50 basis points. It went probably to around plus 30 basis points. And now it's back around minus 10 or 20 basis points again, telling you bond markets in developed markets are very worried around what's going to happen in Eastern Europe. So bond markets very aware of what's going to happen in Russia, and they're pricing for risk. Remember, there's a big risk that Russia can default on its bonds. Why? Because of the exclusion out of the SWIFT system. Now, if we move to emerging markets ourselves, we can obviously work out that big line that's going up. That's Russian bonds. You know, they suddenly moved from, let's say, around 7-8% to around 14-15%. Means the prices have fallen quite a lot in Russian bonds. But they're not alone. Obviously, we've seen Brazilian bonds, Turkish bonds, and even our own bonds take a bit of a hit. Yields move up, so prices fall. So bonds are cheaper. But in South Africa, luckily, remember I've said in previous presentations, South African bonds are cheap. And it's a good thing when your bonds are cheap. It doesn't mean that they won't fall, but they won't fall as much when they move from a cheap price to a very cheap price. So we still think there's opportunities in the South African bond market, but there are risks in nominal bonds that we can't equate at this point because who knows how wars and conflicts plays out. What does it mean for the SARB? Very similar situation than the Fed. I said to you, the Fed may not hike as many times as we all think. Might be very similar for the SARB because remember, this conflict will have an effect on growth. Now, growth is going to be lower this year. Yes, inflation is probably going to be a little bit higher because of the oil price well above 100. Maize prices have just shot through the roof because of what's happened in the Ukraine. Remember, we import a lot of wheat from the Ukraine. So maybe even the SARB doesn't hike that many times this year, right? That's a big change from where we were that we think the SARB will just keep on hiking. Maybe not anymore. Less rate hikes this year. What does it mean for the nominal curve? So suddenly we said to you the curve is still very steep and it will go flat as the SARB hikes rates. Well, maybe the curve stays a little bit steeper because that front end will be anchored, right? So, but still good opportunities in the South African curve, in that latter part of the curve. Let's say this 5-year to 20-year point of the South African nominal curve stays attractive. Good opportunities for South African investors. Why? Because inflation probably is anchored around 5% in South Africa, but those yields are now up at 10%. Now, nearly 5% real yields on South African bonds, that's attractive for investors. Right, so the asset class that we're really excited about in the South African fixed income space is inflationary bonds. Why? Because when you're worried about the rand or currency depreciation or that inflation will be higher than you think, this is the asset class that will protect your savings. Why? Because it's got this inflation accrual element in its metrics. So if inflation goes up, you'll get better returns out of inflation bonds. So if oil stays well above 100, food prices go higher, Eskom gets higher tariffs, well, this is the asset class that will give you good returns. We saw this in 2021 when inflation became a little bit unhinged in the world. Suddenly we had a 15% return from this asset class. So really, this is the one to watch. But if you go into the funds, where do we really sit and where are we positioned? So if you're really worried and you're uncertain about how things play out, you can sit in cash and you can go and sit in the money market fund. It's very exposed to the South African banking system, which is in a good space at this point in time. And we think there are probably returns equal to inflation in this space, but really this is not a long-term investment. You really just want to sit there until you say, well, maybe the world is a better place and I can actually go and invest in markets. If you're willing to take a little bit of risk, our enhanced yield product range is really out there for investors looking for a little bit extra yield above money market. So let's say that 1.5% above money market funds. You've got a lot more credit risk exposure, but a lot less interest rate exposure. So if you're worried about interest rates going up very quickly, then I think the enhanced yield fund is the place to be. Now let's get more excited. Our best investment view fund, which we call our Momentum Flexible Income Fund, right? This is the team's best investment view. So if we said, look, we have open mandate, where can we invest in the South African fixed income markets? This is how we will be invested. And you can clearly see that we still have an overweight position in South African fixed income, nominal bonds, inflation bonds. But yes, it is an income fund, so there's a floating rate component as well. So if interest rates goes up, there will be a benefit to this fund as well. But we also keep cash. You can see we've got about 10% odd in cash. So if we really see markets sell off and South African bonds really become cheap, or that inflation bonds become cheap, or property becomes very cheap, gives us the opportunity to go into those asset classes and really lock in good returns over the next 2 to 3 years for our clients. Then obviously the one that's a little bit in the gray area at the moment is nominal bonds. Yes, I said to you, nominal bonds are very cheap and we still believe that they will give good returns to clients, but this is obviously where the risk is. If Russia should default, well then nominal bonds will face some pressure, right? So it won't be a domestic event that puts our bonds under pressure. It will be a global geopolitical event. But yes, South African government bonds, the 10 years probably trading around 10%. As we said, inflation is at 5%. So 5% real yields from South African bonds looks attractive in a world with a lot of uncertainty. Then our preferred asset class, as I said to you, where we're really excited about returns is inflation bonds. You can see that more than 60% of our fund is exposed to this asset class. Yes, we do have a little bit of nominal credit in here as well, and inflation credit, but we really think that in a world of uncertainty, this is going to be the asset class that really outperforms this year, given that we've seen that oil prices now stay well above 100, that there's a risk to food prices and a risk to growth in the world. We really think that there will be great returns from this asset class over the next year. So how does it play out? We said inflation is going to be 5% this year. Growth is probably going to be not 2% even. So this is not a great environment for growth assets in my mind. So we said, yes, you can go and sit in cash around 5%. Maybe you'll get 5.5%, 6% out of the cash market. You'll probably get 6 to 7% from the credit market if you're willing to take a little bit more credit risk. But we're really more excited around the inflation space where we think this 8.5%, 9.5% returns is really possible. And then, yes, there's a bit of a health warning on South African nominal bonds at this point in time to say that, look, we still think that 7 to 8.5 type returns is possible in this market, but yes, be aware that a Russian default will have an effect on South African nominal bonds, and we have to take that into consideration. But overall, we still think it's a good environment for South African fixed income. But as always, it's good to speak to a financial advisor and get the best view around fixed income allocations. Thank you.
In our previous update in November, we spoke about the renewed hope we had seen for the global economy in 2021, following the breakthroughs made with regards to finding effective vaccinations for COVID-19. We continue to see a ramp up in vaccines across the world, resulting in a significant share of populations being fully or partially vaccinated against COVID-19. As mentioned previously, vaccine penetration rates differ by country, and that will inform how quickly various economies recover coming out of the pandemic. Developed economies have made significant progress with vaccinating their populations, while developing economies like South Africa continue to lag. Nonetheless, the vaccination progress supported the rebound in economic activity that we started to see last year, which was equally positive for the real estate sector during 2021 in terms of improved leasing conditions, improved cash flow generation, and depending on the region, improved transactional activity. On the back of that, we saw a strong rebound in real estate equity markets globally and locally beginning in November of 2020, and that rally was carried over into the 2021 calendar year. On this chart, we show the performance of the South African listed property sector relative to other asset classes during 2021. For the period ended December 21, listed property delivered total returns of 37%. Almost all these returns we've seen so far were driven by the correction in share prices following the sell-off that we saw in 2020. And if you consider returns from when this rally started in November of 2020, listed property is up 60%. There is a huge margin of outperformance relative to other asset classes, and it also indicates that the sector was oversold throughout most of 2020. For us, the other important reminder out of this is that there will always be periods of volatility in the markets. But the most important thing to do during periods of volatility, which admittedly is quite a difficult thing to do when one is going through those moments, is to remember your long-term investment objectives and to remain invested. Looking forward, we think that the probabilities of seeing these kinds of returns repeating itself again in 2022 are low. Our view is that fundamentals of real estate demand and supply, not a correction in share prices, will dictate the direction and performance of the sector going forward. So coming off a period of strong listed property market performance in 2021, there are three questions we want to answer with this slide. How has the listed property sector performed in the first 2 months of 2022? How does that performance compare to the first 2 months of each year since 2003? And can we draw any conclusions in terms of how the sector will perform for the rest of the year, given how it starts the calendar year? So on this chart, we show how listed property performed during January and February of each year beginning 2003. I think what is clear when one looks at this chart is that there have been 8 periods in the last 20 years where listed property started the year with negative returns. With the recent market events in the last few weeks, firstly around concerns about the impact of monetary policy tightening on equity markets, and secondly, on the geopolitical risks we have seen around Russia's invasion of Ukraine, the South African listed property sector has sold off by about 6%. This makes this year's performance the third weakest start to the year we have seen in the history of the listed property sector. The most negative start was in 2020 as a result of the COVID-19 pandemic, followed by the sell-off driven by the governance issues which affected some of the listed property companies in 2018. So if we look at history, periods which started off on a positive footing have historically ended with the sector delivering positive returns for the year. However, in the last 19 years, we've only had 3 periods where listed property started off the year on a negative footing and went on to close the year with negative returns. This was in 2008 during the global financial crisis, in 2018, and in 2020 with the COVID-19 pandemic. All other periods where the sector started the year with negative returns ended with positive returns for the year. But this is by no means an investment thesis into the listed property sector, but a reminder that in the last 20 years, we've only had 3 periods of negative returns from listed property in a calendar year. And that is because dividend yields act as a buffer when capital returns turn negative. The higher the starting dividend yield, the bigger the buffer against potential capital losses. Today, we estimate that the sector trades at a forward yield of approximately 8% compared to the average of 6% between 2010 and 2017. If we turn our attention to some of the big picture trends we've observed in the global real estate sector in 2021, we start with the Commercial Property Sentiment Index, which measures sentiment on occupier demand and investor demand. You'll notice that as economies reopened, that brought with it an improvement in sentiment from tenants and investors into the asset class. Sentiment in some regions such as the US and Europe recovered strongly, with some regions such as Middle East and Africa only managing to catch up in the last quarter of 2021. Interestingly, the positive momentum continued well into the fourth quarter of 2021, driving the index to positive territory for the first time since the onset of the pandemic, despite concerns around the Omicron variant. We've also seen some encouraging developments on the leasing front in the office market. This chart shows total square meters that were available for leasing in the first 3 quarters of 2021, for which lease agreements were reached between landlords and tenants. If we compare leasing volumes achieved in the first 3 quarters of 2021 with what was achieved in the first 3 quarters of 2020, you'll notice that the volume of leases in 2021 were 39% higher than the comparable period in 2020. While this is positive, and while we expect to see an improvement again this year, we think that it will take a bit of time for this office market to find its footing. What surprised most of the market participants last year was the sheer volume of transactions that took place in the global real estate market. After transactional activity paused when the pandemic hit, we saw a decent recovery in 2021 as visibility improved. Transactions were led by the US and Europe, which are markets with very deep liquidity. In the US, we saw transactions clearing at property valuations that were higher than pre-pandemic levels, while markets such as South Africa were relatively quiet. Overall, transactions during the third quarter of 2021 were 4% higher than the same period in 2019. Although we've seen very encouraging trends on the global office leasing market, some office markets such as South Africa remain weak and will likely take longer to recover from the pandemic. As far as leasing volumes are concerned, last year's leasing volumes remained at historically low levels. That was in part driven by the slow rate of vaccinations we've seen in South Africa, coupled with tenants taking longer to commit to office space requirements. Due to the weak trading environment seen over several years in the country, not only are we seeing tenants returning office space back to landlords as a result of their businesses failing, but we're also seeing corporates gradually reducing their space requirements as a way of managing costs. And that is achieved by tenants reducing space when leases expire or subleasing their space to other tenants. Looking at the fourth quarter 2021 office market reports, vacancy rates in the South African property sector reached an all-time high of 16%, leading to approximately 3 million square meters of office space being available for leasing. To put that in context, there is approximately 5 square meters of space available per 100 inhabitants, compared to 3 square meters per 100 inhabitants when vacancy rates were almost at the same levels back in 2003. The recovery we have seen in the retail shopping center market has been very encouraging following the challenges that the sector experienced due to the pandemic. We have continued to see a recovery in both the number of visits to shopping centers, as well as sales levels achieved by tenants operating in those centers. If you look at some of the recent results reported by REITs, we've seen that although footfall is yet to recover back to 2019 levels, the level of sales achieved by tenants have surpassed the 2019 levels. In terms of our preference in the retail property space, we continue to prefer to have exposure to property companies servicing middle to low income consumers, which operate in townships and locations outside of major urbanized areas. Shopping centers in these areas were impacted the least by the pandemic and recovered quicker coming out of the lockdowns, given the high proportion of value and non-discretionary products sold at those centers. We've also seen them outperforming regional and super regional shopping centers, which generally have a higher allocation of tenants that sell discretionary goods. As mentioned in November, the resilience of some of the township retail shopping centers were down by the unrest we saw in parts of KwaZulu-Natal and Gauteng provinces in July. However, good progress has been made in reopening most of the shopping centers that were damaged by the riots, with a few that have not been opened yet planned to open throughout the course of 2023. This slide captures the state of the South African real estate market and largely informs how we have chosen to position our portfolios. It looks at the rate of growth in rental income each year since 2013, after taking into account the impact of rent renewals, vacancy rates, and operating costs. So back in 2013, our rentals were growing at a rate of 5% on a net basis. As a result of the weak economy, the fundamental backdrop for the real estate sector in South Africa has also been gradually declining, with effective growth in rentals approaching 1% prior to the pandemic. The backdrop we've painted informs our portfolio positioning relative to our benchmark. While the SA market is weak, there are JSE-listed property companies that operate in regions with high economic growth projections and favorable real estate demand and supply dynamics. We can invest in these property companies to mitigate the weakness we see in some South African property companies. So if you look at the positioning of the portfolio relative to the All Property Index, we think that some REITs and property companies operating in South Africa and the UK face several headwinds, which makes us less excited about some of those opportunities. On the other hand, we are overweight companies operating in Central Eastern Europe, Germany, and Australia. Our entry point into Germany is through a leading owner and operator of business parks, offices, and industrial complexes with a strong track record of shareholder value creation. The resilience of this company's business model was tested during the pandemic, and our portfolios continue to benefit from the company's robust operational performance, which is translating into strong shareholder returns. In the CEE, we are exposed to Nepi Rockcastle, MES, and EPP, which are all retail-focused property companies. These positions were taken with the view that these companies would benefit from the high economic growth in the region relative to Western Europe and South Africa, high consumption expenditure, low levels of unemployment, and limited supply of real estate space. These factors are all positive for real estate demand and rental growth. It is safe to say that we do not have any exposure to assets in Ukraine. However, these property companies own real estate in Poland, Romania, Slovakia, and Hungary, which all share borders with Ukraine. While the economic linkages between these CEE countries and Ukraine are low from a trade perspective, the economic weakness that we will see in Europe because of this crisis will affect the CEE economies as well. That said, our hearts are with the people of Ukraine during this crisis.
Next up is a comfort break, where we will show you a video about our concentrated solar power project in Uppington. And then we will conclude with Carmony, Paul, and Theo.
Our mission statement is simple. It's about unlocking the green economy. And basically this is part and parcel of unlocking the green economy, basically looking at how renewable energy can play a core part into this whole green transition. Other people ask me about where does the name Imvelo comes from? Well, it comes from the Zulu word Ezemvelo. I remember growing up, my parents always saying, you have to be in tune with nature. You have to be, in tune with the environment. So that's where we take our name from, Imvelo. It's about actually connecting with nature and the environment to do this kind of things.
Welcome to Karushoek, Ilanga 1 concentrated solar power project. Today we have traveled to an incredible location in the beautiful Northern Cape to see how Momentum Investments is building a greener, more efficient future for our country.
The Northern Cape, where we stand today, has got one of the best solar irradiation in the world. And this specific site is in an area called Karos. It's flat land, vast pieces of land. They're ideally suitable for this type of technology. This is what we call a thermal energy storage solution. It has inside it molten salt. So on the right-hand side, we store at 200 degrees Celsius, and on the other side is the hot tank at 400 degrees Celsius. So what do we do with it? It works like a battery because during the day, you're getting your solar field, producing the electricity from there. And part of the steam we put in here, this is your big battery. So there's this analogy that solar cannot run 24/7. The partners we work with, we've configured how we can do it. We can produce base load electricity. That is power around the clock. So this is our water treatment facility. The water comes from the Orange River. We pump it 11 kilometers, and then it comes here, it gets treated here, and then we got our dim water that actually then goes into the facility. It was about how you develop a project in such a way that you can improve the social fabric of the people living in all the areas that are actually surrounding Ilanga CSP1. At the heart of construction, there were 2,000 construction jobs here. The people living in the nearby communities built this with the international guys who brought in the technology. So part of the benefits of bringing something like this is creating the jobs of the future. And in addition to that, creating clean electricity, greener electricity, that is good for everybody's health because there's no pollutants. And at the same time, it's helping South Africa meet its climate change obligations around reducing its carbon dioxide emissions. I think, for me, this can be the mecca of renewables, creating new jobs, new industrialization for the better of everyone.
I am often in awe and humbled by the incredible country that we live in and by the wealth of beauty that we see around us, from the dramatic landscapes to the smiling faces on the people that live here. Taking this trip has once again impressed upon me the fact that we as corporate citizens have a duty to build a better world, to embrace projects like this and to help grow a sustainable tomorrow. Standing here in this fantastic space surrounded by such an amazing project, I'm once again reminded that we at Momentum Investments truly do live our mantra of doing well by doing good. Because with us, investing is truly personal.
"2022 marks the year of the tiger. The tiger being known for its competence and courage in the face of challenge. We saw the epitome of courage as the Ukrainian people stood to defend their country against the Russian invading force late last month. The Ukraine-Russia crisis has captured the attention of the globe and sent ripples through global markets. Global markets have been afflicted by multiple troubles: fears of rising interest rates, soaring inflation, and continuing supply chain bottlenecks. The Russian hostilities in Ukraine will increase uncertainty further. After 2 years in a global pandemic, market participants have been hoping that the theme for 2022 is normalization, and hopefully the beginning of the end of the pandemic. The current conflict has the potential to add further complexity for policymakers as they plot their way towards normalization after the pandemic. There are many shifts and themes that have been shaping markets post the 2020 pandemic. Today, I will talk to you on how some of these broader themes are touching the various alternative investment strategies and our portfolios. One of the mega trends that one has to marvel at is the acceleration of ESG and sustainable investing practices. We know markets have a transformative effect on society and can build a better world. And investor focus on sustainability has never been greater. To that end, the United Nations has set 17 Sustainable Development Goals, which provide a powerful aspiration for improving our world. These have been addressed in many a forum, and I will not be discussing these in detail today. The 17 goals are integrated, and action in one area will affect outcomes in others. As a reminder, these are the goals that Momentum Investments have chosen to focus on. Alternative investment strategies have the unique ability to drive purpose-driven investing through their ability to target investments and to drive policies across portfolio companies and direct strategies. Momentum Investments' Impact Fund range aims to achieve large-scale impact at appropriate long-term investment returns. The range offers an alternative energy portfolio, which invests across a range of clean energy projects offering attractive returns. A social infrastructure portfolio, which invests in projects that are addressing some of the social infrastructure gaps, such as student accommodation and affordable housing, and a diversified infrastructure portfolio, which invests across a range of mature and growth assets to address a range of infrastructure needs while simultaneously offering good returns. Across the portfolios, we are working on our pipeline of executable deals. Our existing mix of mature and growth assets have delivered good returns over the period, emphasizing the robustness of the projects in a still difficult operating environment. There has been an increase in activity, particularly in our alternative energy fund, with a number of transactions currently being worked on. The continuing shortage of energy in the country means that this will be a significant area for the fund to deploy its capital for a protracted period of time. While the Department of Mineral Resources and Energy announced preferred bidders at the end of October for the latest round of the REAP program, it will take another 2 to 3 years for those projects to start generating power. The Risk Mitigation IPP program is mired in court action, which will further exacerbate the shortfall. The increase in the cap for self-generation of electricity should see increased private power purchase agreements being entered into. We are already seeing an increase in opportunities as a direct result. Much work is being done by investors to get comfortable with the creditworthiness of these off-takers. Similarly, with all the country's major metropolitan municipalities also looking to purchase power from independent producers, it's clear that there will be a significant capital to be invested in this area. Sufficient, affordable, and reliable supply of electricity is desperately needed to get the local economy operating at a higher growth rate. In our social infrastructure portfolio, we have added additional capital to our student accommodation investment. This is to fund new student accommodation projects in Johannesburg and Cape Town. Affordable, well-situated student accommodation is still in short supply, and through our investment in this area, we aim to help alleviate this. Our diversified infrastructure fund has seen a steady improvement in the mature toll road investments. Road traffic over the December period had increased from the previous year and was around 10% ahead of budget. The fund's newest investment in CIVH has also performed strongly as it continues with its fiber rollout. The company announced a transaction with Vodacom, which would see a merger of their fiber infrastructure assets. This will add considerable long-term value to the business, and the valuation of the investment consequently increased by 8%. Another mega theme playing out across the markets post the pandemic is that of technological adoption. In the 2022 JP Morgan Global Investment Outlook, global investors cited technological innovation as among the most potent forces generating venture capital, growth equity, and buyout opportunities. Not only among traditional tech companies, but across almost every sector of the economy, driving an expanding opportunity set for the strategy. We have seen this theme across our private equity portfolios. As a reminder, our private equity program follows a hybrid model and invests both in private equity as well as in direct co-investments. This slide illustrates a few of the tech-focused opportunities that we currently have exposure to, either through our direct investments or through investments in our portfolio companies. This chart shows the year-on-year performance to the end of December 2021 for the Private Equity Fund 3. I have highlighted the performance of some of those larger fintech and digital infrastructure exposures in the portfolio, and one can see the clear uplift that we have seen from this theme. The direct co-investment portfolio continued to contribute to the increase in valuation, with exposures to Vox and Channel VAS significant contributors, and still expected to add continued value over the coming years as this theme plays out. This chart also illustrates that portion of the book that has delivered muted performance. Private equity investments are not immune to macro factors and valuations, and deal activity also contracted sharply in the immediate aftermath of the onset of the pandemic. As the local economy continues to normalize, we expect further value uplift from the remainder of the book. Market participants were divided through much of 2021 around the global inflation trajectory, and it became clear towards the latter part of the year that inflation was not as transitory as many investors and policymakers had assumed. There are significant questions around the likely trajectory of monetary policy in 2022, and more so following Russia's invasion of Ukraine, the upheaval likely to be felt differently across the world's major economic centers. Any rise in business failures as a result of monetary policy tightening would put increased pressure on banks' balance sheets and their ability to lend. Small and medium-sized enterprises could be especially vulnerable to any dip in the availability of bank credit. This creates an opportunity for private credit funds to fill the breach by helping to finance businesses that have strong growth potential but little access to mainstream funding. Momentum Investments Special Opportunity Fund aims to exploit high-yielding investment opportunities across the capital structure. investing across unlisted debt, unlisted equity, and hybrid instruments. The corporate debt strategy focuses on direct lending opportunities to unlisted SMEs, with loans typically underpinned by a single material asset or portfolio of assets and guarantees from the sponsors. We continue to see new opportunities and a strong pipeline, reaffirming the quality of the network. The SARB hiked interest rates by 25 basis points in the fourth quarter. Given the majority of the portfolio's debt instruments are floating rate instruments, the yield on this part of the portfolio will increase with upward adjustments to the repo rate, and the portfolio will naturally benefit from further rate increases. The property development strategy has exposure to high-yielding, unique property opportunities. These positions are in varying stages of value creation and realization. Most noticeable over the fourth quarter of last year was the realization of the flagship investment within the corporate recovery strategy. This investment yielded an exceptional IRR of 18% and the saving of over 1,500 jobs, also contributing to achieving SDG 8 to support job creation and growing the economy. An excellent result for the fund, the investors, and the economy. Work continues to uncover specialist investment strategies that meet the portfolio's return objective. This fund has returned a noteworthy CPI plus 5.5 net of all fees since its inception. The alternative investment strategies that I've discussed so far have been those looking to extract an illiquidity premium from private market investments. The more liquid of the alternative investment offerings is the hedge funds, which invests across more liquid instruments and is looking to extract a volatility premium. Which brings us to the last theme for today's presentation. Global markets witnessed an increase in volatility in the latter part of last year, responding to global inflation concerns and the emergence of the Omicron COVID strain. This volatility continued into this year, with inflation, growth, and the Russia-Ukraine conflict dominating market moves. This chart shows the movement of the VIX. The VIX is used as a barometer of risk, fear, and stress in the market, with levels above 30 indicating tremendous uncertainty. The change in the level of the VIX infers the expected daily market moves. One can see in this chart that the VIX at recent levels is indicative of higher daily ranges. This chart is updated to the end of February, and also interesting to note is the increase in the VIX with the invasion of Ukraine at the end of the month. Generally, unsettled market conditions lead to higher levels of dispersion in markets, which is typically what hedge fund managers need to extract alpha. However, trading an event risk isn't easy at the best of times, and the events in Ukraine and the uncertainty to follow requires that fund managers focus on capital preservation and staying nimble. Across our equity strategies, we have a meaningfully long position in gold counters as a broad hedge, as well as a long resource position, which has steadied the portfolios well. With the increase in risk already seen late last year, there has been an increase in hedging through derivative structures and short positioning, and a shift to more defensive positioning across the equity portfolios. We continue to hold our volatility-sensitive strategies for further diversification going forward. This positioning contributed positively to the overall performance for the quarter and the calendar year. Fixed income arbitrage also contributed positively for the period. The investment managers in this complex correctly anticipated the SARB's decision to increase rates in November. The portfolios are positioned for a shallower hiking cycle than the market is currently pricing. Potential vulnerabilities to the rand and the anticipation of a now more structural inflation trajectory are bound to create greater volatility, but also more opportunity, as these investment managers are able to take short positions in anticipation of any weakness. Looking forward, we expect the global news flow to continue to dominate local market sentiment. As I mentioned earlier, the theme for 2022 has been touted to be that of normalization. The current conflict has the potential to add further complexity for policymakers as they move towards normalization post the pandemic. In this environment of heightened uncertainty and increased event risk, diversification across portfolios is key. Given the current low or negative real yields and inflationary pressures, investments such as real assets that can generate positive real yields at a lower volatility are extremely valuable. Higher yielding private credit investments with floating rate instruments, such as those within our Special Opportunities Fund, are also well positioned to protect against rising interest rates. And hedge funds and private equity can provide good public market diversification and alpha.
Hello everyone. In today's session, I'm going to share a few of the highlights of the 2021 Sci-Fi report that gives us a window into investor behavior on the Momentum Wealth platform over this period. Now, a renowned German military strategist Helmut von Moltke famously said, and I'm paraphrasing of course, "No battle plan survives contact with the enemy." Unfortunately, investor behavior in 2021 shows that fewer and fewer investment plans are surviving contact with financial markets either. Let's begin by looking at the overall behavior tax for 35,000 Momentum Wealth investors performing switches, over 130,000 switches in fact, from 2006 until 2021. The diagram shows how the behavior tax intensifies in times of market turbulence. Now, a quick reminder, if an investor holds Fund A and switches to Fund B, we continue to track Fund A as the theoretical buy and hold portfolio and compare this with Fund B at the end of the year. If Fund B performed lower, the difference is recorded as a behavior tax. Now, there were three important things that this diagram shows us. The first is the asymmetry. So more people are destroying value when compared to those adding value by switching. The maximum annual value gained since 2006 was around 3%, while the maximum value destroyed, on the other hand, was nearly 10% per annum. The second important thing is that the behavior tax accelerates rapidly during periods of market turbulence and decreases rapidly, becoming negative, in a bull market. We can see elevated levels during the global financial crisis, or GFC, that quickly dissipates during the subsequent bull market that ended in 2014. As markets become flatter and volatile, however, quickly the behavior tax once again accelerates and becomes more and more severe. Clearly, during the COVID-19 pandemic, levels far exceeding the global financial crisis were recorded. In fact, 6.5% on average in 2020 versus a maximum of 4% during the global financial crisis. The third, final, and most important lesson, though, is that market turning points are unpredictable, and this unpredictability causes a hefty behavior tax. The fact that investors didn't predict GFC or when the subsequent bull market ended in 2014, or the global pandemic, of course, that was COVID-19, means that on average, people always erode value from switching over time. Now, this is a good opportunity for a quick cautionary note as well. There is a lot more uncertainty at the moment with the current conflict. Although this perhaps hasn't quite reflected in markets as yet, switching money around in periods of elevated uncertainty, as history shows us, is always unwise. Remember, we're talking about an average behavior tax here as well, but the average is hiding the thousands of investors destroying double-digit proportions of their savings. This is just an unnecessary drag on people reaching their investment goals, and investors not reaching their goals has been predicted by many to result in what we call the 3 Ds for the financial advice industry. And these are dissatisfaction, distrust, and ultimately disintermediation as investors look at alternative distribution channels. Concerningly, there does appear to be a hint that disintermediation is a little closer than we'd like to believe. A global trend of greater engagement between investors and their savings appears to be a consequence of COVID-19. This is likely from the greater levels of uncertainty the pandemic has brought, and of course, during uncertainty, we like to try and reduce this by taking more control. Naturally, people also have more to lose, which is going to amplify loss aversion. S&P Global report that US consumers have an additional $1.6 trillion in savings since 2020. Our cars are spending more time in the garage. We're not stopping for that Starbucks on the way to work in the mornings. And we're making our own lunches and dinners at home. In Canada, savings to GDP is up over 80%, and in South Africa, it's up just a little over 20%. Concerningly, however, is a recent Canadian survey that shows particularly younger respondents, that's Gen Zs and millennials, are planning to ditch their financial advisors and handle their own investment planning in 2022. The main reasons that you can see on your screens are 54% of respondents want to save money on fees. Now, when we talk about fees, what we're actually saying is the perceived value of advice for these clients is too low. We're all happy to pay for something when we can see the value. This may be linked to a previous point where investors are not reaching their goals. 42% want to have more control, and this is linked to the 25% that go on to say that they don't want to go through a financial advisor to execute on investment decisions and transactions. So once again, this is a perceived value issue. Also noteworthy is that 25% of respondents feel they're knowledgeable enough to meet their own investment goals. So a challenge we as an industry are facing is pretty much around people's overconfidence. Now, if you doubt the power of the overconfidence bias, think the Titanic, think Chernobyl, and the Challenger space shuttle, all of which can be easily linked to overconfidence. In fact, Nobel Prize winner Daniel Kahneman is quoted as saying that if he could wave a magic wand and get rid of just one bias, it would be overconfidence, simply because it often stands between us and critical thinking. There have been a number of studies that have shown that proper financial advice is very valuable. Russell Investments have calculated the value of financial advice at 4.83% per annum. Now, we can debate that, but the 2.02% value they attach to behavioral coaching makes sense if we look at the behavior tax over time we've just seen, and in fact, in certain times, it may actually be much more valuable than this. A behavior tax we haven't even quantified yet, for example, is the one associated with investing too conservatively over an extended period of time. We've identified a large group of investors we call the avoiders, for example, that invest fairly conservatively and then just kind of get stuck there. The behavior tax in this case is the cost of investing in cash versus that of a well-diversified and inflation-beating portfolio over time. We've already discussed two prominent behavioral biases that advisors play a crucial role in managing. Firstly, the financial advisor has a critical role to play in managing investor overconfidence in the information age. This will no doubt be confounded by the self-serving bias. When good investment decisions are made, they're often mistakenly attributed to our own skill. When bad decisions are made, they're brushed off and attributed to bad luck or circumstances beyond our control. This is to protect our ego. The second and equally destructive bias is loss aversion. So losses hurt, and we're desperate to avoid them. Related to this is the action bias. In an attempt to minimize the discomfort that market panic brings, instinct propels us to just do something, when in fact the opposite would be far more beneficial. The role of the financial advisor as a behavioral coach here is critical, but will also require some new skills. The CFP board has recently included psychology in the global CFP syllabus that will focus on harnessing specific skills to manage these biases and bring to the fore the value offered as a behavioral coach. Moving a bit closer to South African investor behavior, we can see a similar and equally concerning trend of greater engagement between investors and their portfolios. In the 2021 period, there was an 80% increase in the number of active investors, or those people performing at least one investment switch. This was accompanied by a 50% increase in the number of switches to a record level of 27,994 switches. The average amount switched was just over 169,000 Rand, and the net result was a little more than 90 million Rand paid in behavior tax for the 2021 period. Now let's dig a little deeper into the roots of this 90-odd million Rand in value lost. Examining risk and return for the time period, it's clear that investors closely followed the ebbs and flows of market risk and return, but often arrive a little late to the party. The diagram on the left shows the Savvy or South African Volatility Index for the 2021 period. The higher market volatility in the latter part of 2020 was matched with predominantly risk-off behavior. Now, how we measure risk-off is basically to match the nearest asset allocation of the Momentum flagship OBI fund to the fund or portfolio switched from as well as to. A negative number indicates that on average, investors are moving closer to the more conservative CPI plus 2% end of the spectrum, or de-risking. while a positive number indicates that investors are moving closer to the CPI plus 6% end of the spectrum, or up-risking. Looking at this corresponding market returns from the JSE All-Share Index on the right-hand side, we can see that returns were comparatively low near the beginning of the timeline. The trend reverses very briefly, but then volatility spikes again, and in March and April, this is enough to keep investors predominantly taking risk off the table. Volatility then subsides, and returns come back to markets, a little more predictably, and the overall trend shifts to investors up-risking their portfolios once more. Finally, we can see that the number of switches during the more volatile period is more than 4 times as much as the latter period, at 6,500 switches on average per month, compared to 1,500 switches per month on average in the beginning. These relationships here are way too close to stem from coincidence alone. It's very unlikely that investors' goals are ebbing and flowing almost exactly to the tune of market returns and volatility. When looking at the trading volumes at the bottom of the diagram, it's almost as though investors or long-term investors are playing the wrong game. Their behavior is closer to that of the day trader that relies heavily on market volatility for short-term profit than to a long-term wealth creator relying on a good balance of assets to outperform inflation. Going into a little more detail and following investors as they switch between different funds, we can answer the following question. Are investors rewarded for making these tactical calls in their portfolios? We do this by examining the investment performance before and after the switch made. So what was the recent performance of the fund invested in or abandoned versus what happened in the next period? The top 4 rows of the table in green show some funds with positive net inflows. The Coronation Global Emerging Markets Flexible Fund, for example, showed positive net inflows of over 30 million rand. The preceding performance of this fund in 2020 showed a healthy 27.73% return. So, were investors rewarded for this? Well, not really. After switching into this fund, investors then earned a negative 9.32% for the year to follow. We can see the same trend in the other funds that showed net inflows. The Coronation Optimum Growth Fund showed inflows of over 8 million rand after generating 22.15% in the 2020 period. Subsequently, however, the fund delivered a negative 3.31% return. The Momentum International Income Fund and Flexible Income Funder funds saw inflows of 28 million rand and 74 million rand respectively after healthy performance of nearly 9% and just over 12% in 2020. Investors then, however, received slightly negative performance in the International Income Fund and 6.45% in the Flexible Income Funds, both substantially lower than the 2020 performance. The next 3 funds show successive examples of those with net outflows. So property as an asset class was absolutely smashed in 2020, and the Momentum Real Growth Property Fund delivered a return of negative 34.89% in an extremely tough climate. The fund saw net outflows of nearly 7 million rand. After investors had locked in this loss, however, the fund rebounded and gave a positive return of nearly 37% in the year to follow. The same trend was evident with the Momentum Focus 5 and Focus 7 funder funds with outflows of over 12 million rand and 14 million rand respectively, after performance of less than 1% in both funds for 2020. In 2021, once again, these funds delivered stellar performance of nearly 16% and over 18% respectively, with the investors having left these funds incurring a substantial behavior tax because they missed these subsequent returns. Today we've examined this concept of a behavior tax, how it's formed, and more recent elevated levels of behavior tax far in excess of what we saw in the global financial crisis. Investors are saving more and becoming more and more engaged with their savings. By using some machine learning techniques, 4 general behavior patterns have been revealed, and what is clear is that different groups or archetypes are destroying value at different times. The market timer, for example, is active in both up-risking and down-risking their investment portfolios, and this kind of archetype performs the greatest number of switch transactions, incurring the greatest behavior tax in 2021 at just over 5%. This is in stark contrast, for example, to the avoider archetype that switches the least, invests the most conservatively, and generally stays away from investment risk. This group incurred the lowest behavior tax of just over 1% for 2021. However, as we alluded to earlier, these investors likely incur a different kind of behavior tax as well. This leaves the assertive investor who is constantly up-risking their portfolio and switching to investments with better and better past performance. These investors incurred a high behavior tax of over 4% and also destroyed the most value, paying over 40 million rand in behavior tax of the 90 million rand in total. Finally, the anxious archetype, who is the most active in de-risking their portfolio and chasing worse past performance, usually when markets dip, incurred a behavior tax of just over 3% for the period. Particularly interesting is that in general with market volatility, the anxious investor is by far the worst affected. In 2020, by far the largest behavior tax was paid by the anxious investor as they scurried to safety when markets crashed in March 2020. Subsequently, these investors completely missed the market recovery, searching for more confidence before climbing back into risky assets. With a market recovery that only took around 3 months, this left anxious investors selling after the crash and buying back in after the recovery. In 2021, however, the ups and downs of markets have cost the market timer archetype much more. In up and down markets, switch frequency and herd behavior are being penalized much more. As we understand these patterns more and more, and as we start to examine psychometric and personality traits of these investors with our investment personality assessment, that's coming quite soon, we'll be in a great position to start nudging both investors and advisors to make better decisions for better investment outcomes. Because with us, investing is very personal.
Good morning, everyone. In preparation for this webinar, I reviewed some of our events over the last 2 years and reflected a little bit on the mood that was so evident to see throughout these events. We started our Moments with Our Investment Gurus event around the onset of COVID, and as a result, I still remember the various stages of lockdown we were in when filming them. I'm certainly thankful that we seem to have weathered most of the storm, and that while we're not completely out of the woods yet, the worst seems to be behind us. Life has pretty much returned to normal for most of us, and the majority of lockdown restrictions impacting the economy have since been lifted. Life moves on quickly though, and concerns over COVID have already been replaced by fears around geopolitical unrest as a result of the Russian-Ukrainian conflict. In addition to this, rising inflation globally on the back of tighter monetary policy employed by central banks has been taking center stage in assessing investment opportunities currently. In uncertain times like these, it's comforting to know that there are a team of professionals at Momentum Investments dedicating all of their time and effort to understanding the impact of these events on their portfolios and to take the necessary action where appropriate. Thank you for joining us today. I hope you've enjoyed the session with us and that you found the presentations insightful and the information helpful in enabling you to better navigate the current investment landscape. As a business, we constantly strive to evolve and to ensure that we have the right funds and solutions to satisfy all of our clients' needs. This means we regularly review our product offering to ensure that it's relevant and spend a lot of time and resources on research to identify opportunities to enhance our offering even further. These webinars allow us the opportunity to show you the outcome of this process and to introduce you to the specialists behind the funds you invest in. Hopefully it gives you a good feel for the culture and the depth that we have in our team. Allow me then to quickly highlight some of the focus areas in our business in the months ahead. COVID has intensified the spotlight on responsible investing globally and also in South Africa. While we've been early adopters of many initiatives, such as being signatories of the UN Principles for Responsible Investing and are active members of the RI Committee of ASISA, we recognize that the ask on asset managers are ever increasing and ESG factors will become even more important in future. We continuously make sure that our ESG principles permeate throughout our business and all of our capabilities, and we're finding new ways of making the impact of our approach even more visible to investors through better reporting. We welcome the role that alternative asset strategies play in creating a positive impact on society. We're excited about our range of impact funds and finding more opportunities to invest in going forward. Product innovation remains key for us, and we're excited to launch our corporate money market and our future trends fund soon. We're firm believers in a systematic approach to equity investing and recently launched a multi-factor equity solution through our systematics team. Transformation in our business and in our industry remains a key responsibility and focus. Our aim is to bring talented individuals through the business and provide them with opportunities along the way. One such example is our internship program, which we launched last year, which aims to give young graduates experience in all parts of our business. The two individuals that joined us last year have settled in well and are gaining valuable experience. Learnings from the current process will be applied in future to even further enhance our program. Through our Innovation Hub, we continue to search for ways to improve our offering, bring technological advances into our investment process, and focusing on ways to keeping investors invested for longer, as we firmly believe this to be in the benefit of our clients. You would have seen some of this through the research shared earlier, and do keep an eye open for thought leadership ideas from the team in future. Today you've heard from the investment team detailing the impact of the current environment on the various asset classes they look after. Here are some of the key takeaways for me. Sanisha showed us what drives inflation globally and the risks associated with this, while also highlighting some of the signs that points toward high inflation being temporary and expected to return to normal levels again in the medium term. Herman illustrated how high absolute valuations across global asset classes puts a major constraint on expected future returns, and that in contrast, the valuation picture in South Africa looks far better. Wayne recapped asset class returns during the previous year for us, highlighting the significant growth experienced in equity funds in general over the period. He also emphasized how important it is to consider the right benchmark when making investment decisions. Ian focused on how all eyes will be on the Fed's interest rates decisions this year and how this will drive valuations in the fixed income space. He also pointed out that the local bond curve still presents good opportunities for investors. Pello gave us an update on the outlook for the property sector and highlighted some of the risks prevalent in this asset class to us. Carmony explained how alternative investment strategies are uniquely positioned to not only provide investors with diversification benefits and the opportunity for higher returns, but also enables the delivery of our sustainable development goals set out for our business. And last but not least, Paul shared some fascinating but also concerning research with us, highlighting how investors are often their own worst enemies when it comes to maximizing their investment returns, and how switching at the wrong time destroys value. As always, lots to consider and digest in optimizing any investment strategy for the current market cycle. Thank you for joining us today and for your continued support. We value your feedback and we strive to enable you with information that's both relevant and valuable in your efforts to manage your clients' portfolios. Please feel free to contact us and share some of your thoughts on how we can improve this event even further. The full video of today's event will be available on our website on momentum.co.za under the Investments and Savings tab. If you've watched the full session, your CPD certificates will be emailed to you once the points have been authorized. Thank you again for your attendance, and I hope to see all of you again soon.